be working on the statement of cash flows. This is one of the several basic financial statements. Today we want to talk about what the statement of cash flows is, how to prepare it, and how to use it for decision making. We want to identify the purpose of the statement of cash flow. We want to really dig into the different sections, operating, investing, and financing sections, what makes them different and how they all work together. We're going to prepare a statement of cash flows using the indirect method and also the direct method. So the purpose really is to report the inflows and outflows of cash. Inflows of cash meaning cash receipts from vendors or any kind of cash. You can get a cash receipt from payment for purchases of stocks. Someone buys stocks from your organization, you'll receive cash. Or you'll get cash in from debts. Maybe you incurred a bond offering and the proceeds you received in cash. So inflows of cash. Outflows of cash is obviously going to be operating expenses, including payment of rent, payment of your employees, obviously purchases of different assets, that sort of thing, paying down of your debt, paying of interest, all of those outflows. So inflows are going to be cash in, cash receipts. Outflows are going to be cash payments. And then also it's going to be important to note that a statement of cash flow, generally speaking, as it's prepared externally, is usually a year's worth of transactions. But you can most certainly prepare this statement of cash flows on a monthly or a quarterly basis. But most often, external users are going to see an annual report. They may even see it in a comparative form. So what it does, it provides the individual and the organization a mechanism for predicting their future cash flows. And very, very important part of organizations, not so much their profitability, it's how well they manage their cash. Because corporations can go out of business if they don't have the sufficient cash to pay their bills, and they can be making a profit all day long. As you know, accrual-based accounting does not consider cash in, cash out. It considers whether or not you've earned the money or whether or not you've incurred the expense. So cash flow is quite important, and it can very well distort why can a person or an organization be profitable and have negative cash flows? Well, hopefully with this chapter you should be able to determine why that is. Evaluates management decision. How well are we using our cash? And that not only means do we have enough money to pay our bills, but any idle money. Are we just letting it sit without doing something, without earning an investment income or being able to pay down debt? So it's important for managers to utilize their monies very, very well, the inflows and outflows of cash. So it's very, very important part of that process. And the ability to pay dividends and interest. Interest most certainly has to do with your debts. Paying back, if you have a bond offering, which we went over in the previous chapter, when you have to pay your interest, and bonds generally pay interest two times out of the year. So it's very important to be able to determine, based on your cash flows, if you have the ability. And a lot of times your bond interest rate will hinge on the ability of you being able to pay it back. So it's very important. And as I mentioned in the first few minutes, it's going to show the relationship between your net income and your cash flows. It's going to explain a lot of things. Why are you showing a profitability when you have negative cash flows? And negative cash flows does not necessarily mean something's bad, but you still should drill down and find out why. It could be that you paid off your debt, a bond offering. It could be that you made a major purchase with cash and not with debt. A lot of reasons, but a cash flow statement does help you identify that relationship. So here we are, balance sheet, income statement, statement of cash flows. Now, if you could see how these I would say these financial statements work together, it's important to note that the balance sheet is as of a specific time frame. Very important. That means if it's going to be prepared as of December the 31st, that's exactly the date that those numbers are accurate. And everybody knows this, but we want to reiterate as of a point in time. Now, period of time, income statement, as you know, income statement could be a monthly one, it could be a yearly one, it could be comparative, year by year, side by side. Statement of equities, changes in equity, again, a period of time, not a fixed position, not a fixed date like the balance sheet. Statement of cash flow, same type of thing. So if you know that and you understand that, you can actually interpret the financial statements and make decisions very accurately because you understand how to use this information and understand the relationship between the timing of it. So There are some sections that are in the statement of cash flow, regardless of how it's prepared, the direct method or indirect method. The operating section is going to be how you show inflows and outflows of your organization. It's really about net income, period. It's about a net income. Anything that helps you generate income or use income, equity, is going to be in the operating section. Obviously, it's going to be any type of sales that you've had for the period, cash part of it. The bills you pay to your vendors, or bills or payments you made to your employees, that sort of thing. When an organization invests, that generally is going to be a bond. Bonds will be in the investing section, quite frankly. Well, actually, we're going to talk about this a little bit more detail, but more importantly, you're investing. You're buying a long-term asset. You're paying off a long-term asset. So if you were to buy an asset of $100 million and part of that asset purchase was secured by debt, you got to deal with that. The interest side of it is going to be in this section, but then the financing side is going to be the equity side. It's going to be mostly buying debt, buying equity. So if someone purchases equity, stock, that sort of thing, it's going to be shown here. The organization paying out dividends to their owners is going to be shown here. It's very important to see how we get all of these different pieces together. So I would like to see some type of example. Here is just operating cash flows. Again, operating cash flows is always going to be dealing with current assets and current liabilities. And that's really about how you operate, how your day-to-day process is. And that means receivables are going to be reflected in the operating section, meaning whether you receive cash from your receivables, for example, or when you pay your accounts payable liabilities. Long-term, the investing section is going to be long-lived assets, period. Buying any kind of asset that you're going to be depreciating over time. If you incur that asset through cash or some form of cash or a combination of cash, it's going to be reflected here. Long-lived assets. So now we want to deal with the inflows. Now we talk about money that comes in to us. Think of examples of opportunities for an organization to receive money. When we talk about outflows out, what type of transactions are actually paid by the organization? Accounts payable. Think about it. If it's accounts payable, what section would that particular transaction show up? In the operating section. Oh, I received cash from a stock that we had actually sold. That's going to be what? In the operating section, in the investing section, or the financing section? If you said financing section, you were right. When we receive cash from equity in the form of common stock, it's going to be shown in the financing section. If we pay out dividends to our shareholders, where would that show up? Let's think about these kind of questions, because when you're preparing the statement of cash flows, you really need to know, you really need to be quite familiar with what type of transactions you're going to see in those different sections. So we have the direct method or the indirect method. The direct method and the indirect method, neither one are overwhelmingly difficult. They're just different. But at the end of the day, you're going to always make certain that your balance is going to be the same. Your net cash provided by operating activities will not be any different regardless of the method you use. And it's very important. One is just taking the accrual basis of accounting, which is the indirect method, and it's reconciling or removing all of the non-cash transactions. Where the direct method is just grouping specific transactions. Cash provided for operating activities like cash paid to customers, cash received from customers, cash paid to vendors, cash paid for this. So it gives you in different categories. I would say both are very, very good methods to use, and it really does depend on the organization. The indirect method, I would say, most often is used. If you check out different organizations that provide their financial statements online, you can see right off the face of it. And you can, okay, many organizations are now using the indirect method. Why? Why do they use that method? And what process they use? But either method are most certainly acceptable. So in this example here, you can see how we reconcile down from net income, which is accrual basis, and bring it down to cash basis. So we remove all non-cash transaction, and depreciation is a typical one. Cash collections from customers. Again, this requires a calculation, because again, you're having to deal with receivables, changes in receivables, changes in inventory, again, changes in accounts payable. Why do I say that? It's because these transactions often have a cash portion of it and a non-cash, and you have to do a little bit of more of a calculation to extrapolate what the cash effect of those transactions, which makes the direct method a little bit more cumbersome to do and a little bit more complicated. But it's important that you know both ways. So how do we prepare a statement of cash flows using the indirect method? As I mentioned, you are going to be reconciling. You're going to go from the net income, and you're going to be drilling down or removing any adjustment that requires any adjustment that has a non-cash effect. And we already talked about amortization, depletion, and depreciation. They are non-cash transactions. They should be removed. How do we remove them? If net income is decreased by those transactions, we're going to have to add it back. And as you can see, depreciation reduces, or is a reduction in equity. It reduces your net income. So when we're doing our reconciliation and we're adding, we have to add that number back. Now, again, loss from long-lived assets. Again, if you have a loss, that's going to decrease income. So you have to add that back. It's like in any of the expenses, any expense that you have as non-cash effect, you have to add it back to net income because it was computing net income by reducing it. So losses, decreases in or gains. In this case, gain is an other income item. It's increasing net income. So we have to remove it. So in order to remove that, we have to subtract it out. We have to make the opposite effect. And this really becomes quite important to be able to see the relationship between these transactions and how it affects net income. Because if you understand how it affects net income, you know whether or not, if it's going to increase my net income and it has no cash effect, I'm going to have to reverse it. I'm going to have to decrease it. If it's going to decrease my net income and it has no cash effect, I have to add it back. And if you think about those relationships, it becomes quite easy to determine the appropriate adjustments and how to add, or whether to add them back to net income or subtract them from net income. And some examples here. If you have a decrease in a current asset, what happens? Let me give you an example. Accounts receivable. We debit accounts receivable for $5,000 and we credit revenue. We earn the revenue, but the customer has 30 days to pay it back. So if an asset increases, and that's the transaction, and it's reflected in net income, you have to remove it because it has no cash effect. So what happens if your customer actually pays you for your receivable? Therefore, you get a debit of cash and a credit of accounts receivable. We then have to deal with, this is a cash effect. So we have to increases in current assets. Decreases in current assets other than cash. So this particular transaction has a net effect of 0, but in the end, the general rule of thumb will be, if my current asset is going up, I need to decrease it. If my current asset is going down, I have to decrease. Opposite effect is on accounts or current liabilities. If my current liability is going up, meaning I'm going to have to debit an asset and credit my liability, that means I'm going to have to do what? I'm going to have to add that back to my net income. If my current liability is going down, I have to decrease it. And these little examples will be very, very helpful. And in fact, if it's possible, I would most certainly have you take this particular exhibit and print it, because it will be a great guide in a form of a cheat sheet to help you navigate through creating the net increase or decrease in cash. And that's what I would most certainly recommend you do. The next section is the investing section. Again, we're going from top to bottom, but this section is not going to be any different regardless of whether you use a direct method or indirect method. The most important thing to note is the indirect method, it only makes a difference in the operating activities of the statement of cash flows. The other sections will be exactly the same. So when we're talking about how do we determine what items in our operating activities get subtracted and what gets added, it is important to refer back to this schedule here, because it is very, very clear. Increases in assets. Is it a current asset? If it goes up, what do? We want to subtract it. If it's at the current asset and it's being decreased, we're going to add it back. And the same is true for income, whether it be losses or gains. A loss will be reducing income when you record it, so we have to add that back. A gain will be increasing income, so we have to subtract that. So if you think about it, it's very intuitive. It's just I think the most important thing to remember is, what is that transaction doing to net income? Is it making it go up? Is it making it go down? If it makes it go up and it's a non-cash, we have to subtract it. If it's making it go down, we have to add it back. That's really important to note. What is the effect on net income? So using the indirect method, I would think most importantly is to see the relationships among the different types of accounts on the balance sheet. And one of the things that you can do is like this example here. Some software programs do have a component that allows you to prepare a statement of cash flows, and certain accounts are automatically flagged, and so you don't have to do the calculations manually. But in a classroom setting, looking at the balance sheet as it states, looking at the changes in those different accounts shows you the decreases and increases in what you'll have to do in order to use that information to prepare the statement of cash flows. As you can see, changes in cash went from 42 to 34, so there was an overall decrease of 8. Now, how do we account for those changes in cash? We most certainly have to consider some of these accounts are not going to be affecting the operating section. Why? Because long-term assets are going to be shown on the investing section of the statement of cash flows. That's case in point. So in our little example here, we can deal with the changes in operating by isolating cash, receivable, inventory, and prepaid. All of these are operational. All of these are current assets. And then if we have some changes in our long-lived assets, we know for the fact that our long-lived assets are going to be shown in the investing section, and we have to consider those. And not only we consider the change, we have to determine if those changes have a cash effect. Obviously, cash has a cash effect, but what are these plan assets and note receivables? Do they have a cash effect? If they have a cash effect, we have to reduce them from our statement of cash flows in the investing section. So we have to consider those. Now, again, going down to the liabilities, same thing. If you look at your liabilities, the current liabilities are going to be on the operating section of the statement of cash flows, and long-term debt, if there is any, is going to be shown in the financing section. So the most important thing, interest obviously is going to be in the operating section, and the principal portion of your debt is going to be in the financing section. So the most important thing to think about with financing, long-term debt's going to be there. Dividends are going to be there. If we're talking about investing, we're talking about assets that have a long life. If we're talking about the operating section, we're going to talk about current and non-current assets and current liabilities. And that's a very general statement, but it will definitely narrow the possibilities of how you can create the operating section of the balance of the statement of cash flows accurately. Because once you know what your activity of those items are, then you can say what's the relationship. Once you know what accounts that you need to think about, in this case cash and receivables and inventory, now you can say what are these transactions, how do they affect the net income that we computed in the previous in our income statement, and what's that change. And if we can analyze that change, we can then plug in those numbers and create the operating section. So and then also when you're talking about dealing with gains and losses, this is just giving you a clear example of what happens when you record gains. Gains are income. If there's going to be a gain on a sale of an asset, you're going to have to show this gain as a reduction in net income. And the same is true for depreciation. You can see here depreciation is reducing net income. So that means you have to do the opposite. You're going to have to add that number back. Here we added it already to compute net income. We have to remove it. Here we subtracted it to create net income. Now we have to add it back. Looking at the income statement in this way does help you see the relationship between that transaction and net income, and it will allow you to be better able to adjust for it on the statement of cash flow, meaning either you add it back to net income or you subtract it, and it makes more sense. So cash flows from net operating activities we're going to talk about the transactions that make up net income. Obviously, we're going to talk about what we start from. We start from the income statement, and we're going to drill down. We're going to take our net income and add any transaction that reduces net income, add those items back. Any gains that we receive that increases net income, we're going to subtract them, and any losses that we incurred or other expense, we're going to add them back. In comparative statements, we're also looking at the changes that are in current and non-current, current assets and current liabilities. Again, we're analyzing the changes. Not all changes in our current assets and current liabilities require us to reflect it on the statement of cash flow, but this is how you start. We have an overall change in our current liabilities. What accounts were changing? What happens with our liabilities? Did it go up? Okay, if we're using the indirect method, we have to consider that. If we have an asset that goes down, a current asset that goes down, we have to consider that in our statement of cash flows using the indirect method. And this is just giving you a reason why we add them back and how we're converting net income to cash flow. That's exactly what we're doing. All we're doing really is taking accrual basis net income and converting it to cash, essentially. And again, we're saying with gains and losses. A gain is going to be an other income item. We have to remove that from our statement of cash flows. And a loss is an expense, and it reduces net income, so we have to add that back. Again, we have to deal with those transactions based on the impact it has on the income statement and on net income. And again, this is the same type of thing as we're analyzing the operating activities, and we see these changes in current and non-current assets and current liabilities. They have no transactions or have no relationship to cash or no cash effect. We have to make certain that we have to remove those items from the statement of cash flows to allow us to have that net income or that net operating cash and net cash used in operations. So again, current assets, current liabilities have to be, again, if your liability goes up, your current liability goes up, what do you do? If your current liability goes down, what do you do? And again, it's all about how these transactions affect the balance sheet and how it translates over to the statement of cash flow. All of these relationships are very, very important, and these little rules are really strong so that you can rely on them. So using this particular exhibit could be very, very helpful for you to prepare the operating section of the statement of cash flows. Increases in current assets, what do we do? Decreases in current assets, what do we do? Increases in current liabilities, whether it be accounts payable, wages payable, or accrued liabilities, what do we do when we decrease them? What do we do when we increase current liabilities? It doesn't matter which one it is. And if you can get those general rules of thumb in place in your mind, preparing a statement of cash flows can be quite easy to do. So, investing activities, obviously we're going to talk about planned assets, any type of long-term investment, increases and decreases. We want to also consider what is a long-lived asset. We went through that in another chapter. We're talking about buildings, plants, equipment, anything generally we're going to depreciate, amortize, or deplete. So here we are. And this is just giving you an idea of how to compute what amount you need to remove. Again, depreciation expense, if you're using the indirect method, it has to be completely eliminated. If it reduces your income, it has to be added back. And that's major information. Again, we have to just be certain that we know exactly what the gain or loss is. And knowing the book value of the asset is going to be important as well. So, and this is all review. You already know how to compute depreciation depending on the method you use. The most important thing to note is when we remove these items from our statement of cash flow, we remove the correct amount. The non-cash portion of it we're removing. The investment section of that balance of the statement of cash flows is only going to show the flow of cash or in or out. If it has no cash effects, it's largely ignored, and that's very important. You can buy all types of major projects and pay them over 3 to 4, 5, 10 years, but if it has no effect on cash, it's never going to be seen on an investment section. What's going to happen, you might make a footnote disclosure of that purchase, but it's no effect. We're only concerned with, regardless of how we go through this process, we're only concerned with the cash effect. Inward cash, outward flow of cash. Anything that does not have an effect on cash is ignored completely in any of the three sections. Now, financing section, again, what's included? Note payable, bond payable, long-term debt, common stock, paid-in capital. Note payable bond payable, we're concerned with the principal portion of these debts. The operating section will be talking about really concern itself with the interest. Interest will not be shown here, and it's very important. Only the principal portion of these debts. And the equity, clearly equity, common stock, all of those. So we got to think about these transactions. Again, looking at your balance sheet is going to tell you, is there a change from one period to the next in these particular areas? If there is, investigate it. If there is a change, what's the cash effect of it? If it has no cash effect, it's ignored. So, for example, you have a note payable, and you receive cash, so you got to deal with that. That has to be noted on the balance sheet. But what if you have a reclassification of your bond payable, meaning you change from long-term to partly short-term? That's no cash effect. What happens is not shown on the statement of cash flows. We only concerned with the inflows and outflows of cash. So number one, did it have a cash effect? If it did not have a cash effect, you ignore it. If it did have a cash effect, then where do we place it within the statement of cash flows? If it's operational, then we have to deal with that. If it's not operational, whether it be investing or financing, we need to know what are the criteria that we must meet in order for it to be in the financing section. What criteria is necessary for it to be in the investing section, and we place it there, whether it be an increase or a negative or a decrease. So, issuing of new stock, again, financing section of the balance sheet, of the statement of cash flows. Why? Because equity, increases in equity is going to be in the financing section. So we have to consider, we issue stock, we're going to have to show it in the financing section of our statement of cash flows if it has a cash effect. If it doesn't have a cash effect, do we care? Yes, we do, and I'm sure we will be disclosing those transactions on our financial statements, and we can also disclose it depending on how significant it is. We can also show it on the face of the statement as a little note or disclosure. But for the transactions that we are shown in our computations, it is largely ignored. It is not going to be shown if it doesn't have a cash effect, and that's very important for this statement. Cash we receive, cash we pay out, we show it. Everything else we ignore. So the direct method, again, the direct method is going to be preferred, but let's just make certain that we know how to do both, because I would say most companies are going to be using the indirect method, and it's really important that you understand it very, very well. But we're going to talk about the direct method. Direct method is going to be grouping transactions, particularly within, we're talking about the operating activity section and not the financing and investing, because those sections do not change. But in this section, we're going to be grouping different types of transactions in categories: cash receipts from customers, collections or other receipts, and so forth. Cash payments to suppliers, cash payments to employees, payments of other operating expenses can be grouped, or payments to interest. So in this section, we are going to be grouping the different types of inflows and outflows based on categories that you see here. We're going to be showing, and when we talk about the depreciation and amortization, they're not going to be shown at all. They will not be shown at all. Only thing we're going to be showing are the different categories that we mentioned here. Depreciation, amortization, not listed using the direct method because they have no effect on cash. So the investing section and the financing section have no changes. It's really going to be solely the operating cash flows that's going to differ in presentation depending on indirect or direct method is used. But it's very important that the bottom line number, net cash provided by or used for operating activities, will be exactly the same regardless of method used. So your task would then be to understand the relationship between the current and assets and current liabilities and how it affects the operating activities section, the different types of categories that are required to be disclosed when you're using the direct method, and how to reconcile the net income to the cash used or provided by operating activities. That's very important. That's your first task. Your second task would be to how do you determine, or how can you determine what accounts belong in each specific category. And that's important as well, because one of the major problems that I've seen in statement of cash flow and preparing it is you putting it in the wrong category. You're decreasing cash, yes, but you're putting in investing when it should be financing. So recognizing that and learning how to differentiate the different types of transactions and where they belong. And more than anything, understanding the relationship and what the purpose of this statement is. It does show you the inflows and outflows of cash. It explains how you use your cash, how you receive cash, and it does give an organization and anybody looking at your process how well you can meet your obligations, both current and non-current. I'm hoping that this chapter overview gives you some idea of what you will be expecting to be covering and what you'll need to learn while we cover the direct method and indirect method of statement of cash flows. Thank you very much for your attention.